I
All
thought
right.
it already was recording.
Um, no, I think we've just started recording now. At least
Oh,
I'm
I see.
starting to record on my computer. We had the I think, taking notes. So, thanks for joining us, everyone. For those of you watching the recording, we appreciate you going to the YouTube channel and subscribing to the channel as well. Thanks for doing that. So today we'll be talking about a couple of things. So we'll talk a little bit more about we'll attempt to read the tea leaves, I guess, about Kevin Warsh, the presumptive Fed nominee. President Trump had announced, I think, at the end of January that Kevin Warsh will be the nominee for the Fed chair. And then we'll talk a little more about what's been happening to the yield curves over the past few years. So that's our plan. And Hadi, does it make sense for me to start and talk about Kevin Warsh first, or do you want to talk about
Yeah,
the yield
let's
curves
talk
first?
about Borscht first, and then. But my presentation is relatively short,
Okay,
unless
all
there are
right, sounds good.
questions.
So give me 1 second. So I'll start sharing my screen and I'll share my presentation. So that's hopefully everybody can see the screen. So we'll talk about Kevin Warsh, his background, views, and possibly make even some predictions about what will happen in the future. Even though predictions is a very unthankful business, right? Sort of reading tea leaves is not something that we are best at necessarily. So, and then we'll talk about the dynamics of the yield curves in the past few years. And if you're currently taking the money and banking class, that might be really useful for you as modules 5 and 6 are coming up. And so let me start by talking about Kevin Warsh. There is a whole bunch of articles that I shared already on the group site on LinkedIn. So take a look at them. So I've added Kevin Warsh's remarks at the G30 IMF lecture last year to this potential reading list. I think it's an excellent read. And let's begin by talking a little more about Kevin Warsh. So um, President Trump obviously likes good-looking people, so he's a good-looking guy with excellent credentials, obviously. So undergraduate degree from Stanford, law degree from Harvard Law School. Back in 1995, the career had been a very illustrious career. He started his work and rose to being responsible for mergers and acquisitions at Morgan Stanley over a 7-year time period in 95 through 2002. Then he moved on to government policy and became special assistant to George W. Bush, special assistant for economic policy, and he became the executive secretary of the National Economic Policy Council. So he became I think he probably was the youngest Fed governor, and so he became a Fed governor and was governor, 2007 to 2011. This was, as you recall, a very tough time for the Fed. This is the midst of the great financial crisis. Kevin Warsh is often credited with potentially helping to save his former employer, Morgan Stanley, who obtained a banking license or the bank holding company status the day after Kevin Warsh was allowed to start dealing with them again, and so Morgan Stanley was in dire straits, and that basically saved them from ceasing to exist potentially. He represented the Fed in the talks to G20 countries in the international outreach. He's often credited for his responsibility in creating the Division of Financial Stability at the Fed. And after the Fed, he took up the career of teaching, board service policy, private investment management, and so on. And so obviously, this should have been January 30th. Forgive my typo. So President Trump stated that Warsh will be nominated as the Fed chair. And here's some interesting things here. Sorry, I'm not getting my presentation to move. Okay, so here it started again. So I wanted to talk first about his policy views. So one thing that we probably should recognize right away is that Kevin Warsh's stance on interest rates probably could best be described as mixed. Because while he was a Fed governor back in 2007, 2011, he was one of the most ferocious inflation hawks. And he worried quite a bit about possible price surges. So, as you recall, there were really no price surges during that time period. All of that sort of accumulated and came sort of came to life only after the COVID crisis, right? But that was his reputation. So right now, Kevin Warsh is actually supportive of interest rate cuts, which is exactly what President Trump wants him to do. And so there are a couple of explanations here why this might be the case. And so I'm not quite sure if those explanations are credible enough, but sort of I'm hoping Hadi can also chime about into this now. But one of them is the argument that sort of the Trump administration has significantly deregulated and continues to deregulate the economy. And second explanation is that there is a productivity boom from AI. And the logic here, the way how I see it, is that two of those things basically are expanding the economy's production capacity considerably. And so if the Fed takes the action of cutting the interest rates now, it actually will not continue to contribute to inflation because it will simply help the economy to expand to reach that new production capacity that has been unleashed. So, Hadi, what's your take on two of those arguments? Do you think what's your sense about whether deregulation of the economy and the productivity boom from AI have they already expanded the production capacity significantly so that we can cut the interest rates even more now? What's your take here?
First, on the production capacity and its relation with AI, I think what Warsh and others are saying is that one has to be proactive.
Mm-hmm.
Although AI may not have generated a whole lot of productivity growth right
Mm-hmm.
now, but in the next couple of years it will.
Mm-hmm.
And therefore they think that because it takes time when they cut the interest rate to get the impact on demand. It
Mm-hmm.
takes a year or so,
Mm-hmm.
between 6 months to maybe 18 months.
Mm-hmm.
So they think the production capacity is expanding and they better act
Mm-hmm.
now.
So it's
And
basically a forward-looking argument, right? Sort of saying
right.
that there should be cutting rates now to accommodate the actual lag in government policy that exists.
Exactly. And when I show the yield curves, I'm going to discuss this issue again because yield curves are really great uh, means of communicating or trying to understand what may be coming to the economy. On the inflation issue, you also wanted me to comment on that one, right?
Mm-hmm. Yeah.
Right. I think many economists were at the time in that on that side of the debate. They were concerned that inflation might come back with a vengeance because
Mm-hmm.
during the financial crisis, money supply had expanded at rates that never had people had not seen before,
Mm-hmm.
and it didn't happen. And I think a lot of people realized that they had overestimated the tendency towards inflation. And that pendulum moved to the other side until they made the mistake of creating a 9% inflation after COVID.
Mm-hmm.
So now I think everybody is a bit more balanced and they realize that you need to be proactive. You
Mm-hmm.
need to also be careful about the conditions of the economy and
Mm-hmm.
do not assume that past is going to be repeated very easily.
Yeah.
Every time we face new situations.
Uh-huh. Thank you, Hadi. RPG, I see a hand up. Go ahead. What's your question?
Sure. Thanks, Professor. I I finished my microeconomics and macroeconomics a long time ago, so I may not be all remembering all the theories that I learned. But one thing that is stuck in my mind is cutting down the interest rate will definitely increase inflation on the other side. But here you're saying, is it production capacity that you are trying to mention as a reason for possibly not being the reason to
Yeah,
increase
yeah, yeah.
inflation?
So obviously there is a trade-off between inflation and interest rates, right? Or sort of inflation between there is a trade-off between uh, there is a trade-off between the two goals that the Fed has, right?
Dual
Sort of
mandate,
it
yeah,
has to
that's right.
control the
Right.
inflation and it has to minimize
Unemployment.
unemployment and to maximize the employment, right? And so,
Mhm.
sort of there is potential that if you cut interest rates, that, sort of inflation, if you cut interest rates to increase economic activity, then inflation might increase. But the idea here is that the inflation rate is going to increase only if you're currently at the point where the economy is operating at its production capacity. At this point, if you push it harder, all that happens, or all that mostly happens, is that prices go up, but the output expands by only a little bit because the economy is overheated already, right? And so the argument is here is that if there are things that actually expand the economy's production capacity, the ability to produce more goods and services without, sort of without an increase in inflation, then this is where stimulating demand to kind of push the economy towards that new production capacity, this is where it can make a difference, right?
Got it. Got it. Okay.
Okay.
Makes
All right.
sense.
Very good.
Makes total
Okay.
sense. Thank you so much.
Excellent. So and that seems to be the argument. And so I'll say this: if you looked at the Economist articles that we've shared with you, the Economist seems to be very skeptical about those two claims. So I don't think that we are seeing productivity boom from AI yet. Um, though it's pretty consistent with the research, right? Because generally the productivity boom from general purpose innovations tends to be lower at first and then it increases. And even though the administration obviously cut some of the red tape, I don't necessarily think that it has cut a huge amount of red tape to say, oh, this is how we get to the higher production capacity, right? So there is some skepticism in there. I might not be quite as skeptical as the economist writers are, but there is skepticism nonetheless. But let me go back to the Fed's balance sheet, right? Because this is another interesting item in here. So Hadi noted that in the last 20 years, and I have so many typos here, I'm sorry, I will fix them after I share this, but this was supposed to be 2005. If you look at 2005 to 2025, the Fed's balance sheet increased from 800 billion to 6.5 trillion, right? This is a huge increase. This is, what is it, about 9 times increase or so? So very, very significant, 8 times increase. So at the very same time, so what we had is that the Fed ended up shifting from a limited reserves environment to an ample reserves environment, which required the Fed to change the policy tools it uses to control inflation. We used to have relatively little money in circulation. The Fed could very surgically buy and sell government bonds to the banks in the federal funds market, and to move those interest rates to where it wanted them to have. In the ample reserves environment, there the amount of money in circulation is very, very high. Those tools stopped working, and so the Fed went to the direct interest rate targeting, right? And created new facilities such as the reverse repo facility that exists to suck out the money from circulation, right? And so if sort of Kevin Warsh's stand is that the balance sheet for the Fed needs to increase significantly because it creates market distortions, right? Essentially, the idea here is that if there is so much money in the economy that is controlled by the Fed that resides on the, that is on the Fed's reserves, right? It can create significant, sort of disincentives to economic activity, and that is certainly not something that is healthy at all. And so if you think about this, sort of like there is obviously there is obviously conflict between the combination of views for lower interest rate and the tighter balance sheet for the Fed. So very unusual. And we'll have to see how something like that will play out if Warsh is indeed confirmed as the Fed chair. Okay. And so let me just take a small pause now. I see that there is a good amount of activity in the questions. Vitaly, do you want to voice out some of the questions that you had so far?
Yeah, just a quick one. This balance sheet growth, how much of it can be kind of linked to the quantitative easing in 2008, 2009, right? Was it the main source? And second, like what do you do with that if the assets are kind of worthless? Do you just write them off?
Well, those assets are not worthless. Sort of this is not necessarily an idea that this is bad debt that the Fed took on. It's not, right? The idea here is that as sort of like the great financial crisis was happening, to an extent as the COVID crisis was happening, the Fed was taking on a number of assets onto its balance sheet. And so the goal of the quantitative easing was essentially to preserve those asset prices, right? And Hadi, please correct me if I'm wrong here in describing this logic, right? So, but so if you're seeing, for example, mortgage-based securities suffer, right? After the great financial crisis, if their prices go down, that basically means that private investors are likely not going to be interested in funding mortgages anymore, right? If that's the case, then what we can expect is, banks charging higher interest rates for mortgages and the demand for mortgages going down. And if the demand for mortgages and the demand for housing goes down, that essentially means that the prices of real estate could go down significantly. And so if you think about a typical household in the United States, what is that household main source of wealth or main instrument where it holds its wealth?
Yeah.
It's the house. It's a house that you own. It's your real estate, right? And so, and again, I want to emphasize that this is probably your average household, as in the median household, because there is obviously a lot more households that have very significant amounts of monetary holdings. And so if you take them into account and if you run a mean, so that might not be the most important asset, but for your median household, it absolutely, your house is the most important asset that you have. And even if you're not impacted otherwise by the financial crisis, right? Even if you're able to retain your job, right? If your income hasn't changed, but at the very same time, your wealth changes and your wealth goes down, then what would a normal, logical, sort of economically rational household do? It would start spending less money on consumption, right? And it would try to save more money. And if everybody acts this way, or if a significant number of people acts this way, that basically reduces the demand for goods and services and can lead to additional economic correction. And this is what the Fed was trying to prevent by essentially buying those assets to preserve their prices and to preserve the ability, of the mortgage markets and the real estate markets to function, right? So that's what the Fed had done. And so if, and by definition, if you're looking at the balance sheet, sort of like a lot of that expansion came from the mortgage-based security. A lot of that expansion came from, essentially the change in the monetary policy where the Fed wanted to have more money in the circulation. And the big chunk of that too came from the Fed starting to purchase more long-term security, including, primarily government security, primarily treasuries, right? To maintain their prices and potentially to shape a little bit the longer term yields as well. And this by the way tends to be one of the criticisms because of that Warsh would normally have, right? Because if the Fed is spending a lot of money on sort of on shaping yields and things like that, right? It can create economic distortions because the interest rates on those no longer reflect what the market believes they should be worth, right? So, Hadi, anything to add here? Did I get this correctly?
Yes. Good
Okay.
job.
All
Proceed.
right. Excellent. even even a blind squirrel finds a nut every so often, right? That's what I usually say about my successes. Okay, very good. Did I answer your question, Vitaly, or did you want something else to ask?
Yes, you did. I asked 4 questions at the beginning of the session. 2 of them
Uh-huh.
were answered, even like you had it on your presentation. I have 2 more,
Uh-huh.
and maybe you are going to cover it. So, what should be number 2 and number 3, basically? What take should we expect from Kevin on Federal Reserve independence from the government? Because if Trump promotes him, right, it might mean that they're getting along and Trump expects more leverage on his side, probably, right? So, what his take on independence? I think he was like announcing publicly that Feds should retain independence. And number 3, again, take on cryptocurrencies. It seems very different from Trump's.
So yeah, I probably won't be able to comment much about the take on cryptocurrencies, even though what we've seen is that since his candidacy was announced in late January, the cryptocurrencies suffered even more, right? Sort of, if I recall correctly, the Bitcoin is under $65,000. That's been a very, very significant correction, right? So, but I also want to remind you that President Trump was skeptical about cryptocurrencies because he was before he was very enthusiastic about cryptocurrencies. So I don't know if it's necessarily a policy disagreement there on that part. But in terms of the independence from the government, there are a couple of sorry, I'm trying to get the mouse to work again and to advance. Okay, I have started working again. So if I go back, if I go forward to my next slide. So the idea in here is that Kevin Warsh wants a leaner, smaller, and less interventionist Fed. He does suggest a new Treasury Fed accord. And so for those of you who might not recall or know what this basically was an original agreement in 1951 that the Treasury and the Fed achieved together. And this kind of marked, goodness, this is 75 years since that time, right? Sort of this separation of monetary policy responsibility and government debt management. This is kind of like the beginning of the Fed's independence as an institution, right? Essentially, this agreement took away the Fed's responsibility to hold down the United States borrowing costs, because that might make for suboptimal monetary policy, and it essentially enshrined its that kind of enshrined its independence, right? And so I think from this perspective, sort of a Treasury Fed accord might not be necessarily something extremely different from what we had, but this potentially can clarify the institutional roles more. Because Warsh arguing that the Fed actually may be similar to the European Central Bank, should focus more on inflation and financial stability, but the job growth should be a fiscal function. It should be function of the government rather than of the monetary policymakers, right? And so so I think from this perspective, what we could expect is fewer interventions. And Fed would very often in the past pick the slack, because if you think about fiscal policy requires, sort of basically the decisions on taxing and on spending. This is what the legislative branch and the executive branch are responsible for, right? The legislative branch establishes the policy through laws. The executive branch executes that, right? And so essentially what Warsh is saying is that, the Fed would jump to, fix essentially the inability of the federal government to engage in fiscal policy with quick actions on the monetary policy. And Fed should do more of this, and the rest of the government should do its job in fiscal policy better, which is not necessarily an unreasonable stance. But whether it's a practical stance, that remains to be seen, right? And so it seems like Kevin Warsh also wants to realign the Fed's portfolio back towards shorter term assets like treasury bills that have historically been used to shape the monetary policies, right? So, and elected officials should start using fiscal tools as a first response if a crisis arises, right? So if you look at critics, the critics think that, yes, there is certainly a potential for more political influence over monetary policy and reduced independence from the Fed. But there is concern about potentially an increase in long-term borrowing rates because, essentially, if the Fed doesn't buy longer-term instruments for its portfolio anymore, and if it gets rid of the instruments that it has right now in its policy, then that can potentially mean that the long-term borrowing rates would become higher. And so that obviously would be a significant increase in the government's expenses, right? And okay, and I think if we go to the expectations, if you looked at the 4 possible candidates, Warsh actually, and this was a nice surprise, at least it probably was for me, he is the candidate who had the most tight money stance out of the 4. So basically, that's a plus. So we expect him probably to concentrate more on inflation because this is what his statements point out to, and leaving more of management of unemployment to the government itself. Kevin Warsh doesn't seem to be a big fan of forward guidance, which is the set of actions where Fed or where central banks in general tells the markets what can be expected through statements, through other actions, right? And so that forward guidance is something that he doesn't want the Fed to do. And if you look at the investors' reactions to his announcement as the candidate for the Fed chair, generally speaking, the reactions was pretty decent and pretty muted, right? So there was a minor correction in the equity market. Gold and silver price, in particular silver price, I think went down very, very considerably. I haven't even realized until January as to how much the silver prices actually climbed up, and so they corrected quite a bit. The dollar strengthened, and the treasury yields increased somewhat. And so Hadi will talk more about treasury yields shortly. And then there obviously was more crypto volatility. And so, sort of from this perspective, if you look at the investors' reaction, they don't really see significant changes, I would say, right? Sort of they're looking at the Fed that is still very concerned about inflation. Maybe it's concerned about inflation a little bit more than it's concerned about unemployment and economic growth. I think this is one of the arguments that Warsh is making about concentrating on inflation more, and that's not necessarily a bad thing. So from this perspective, I don't think that we're expecting the world to end if Warsh is appointed as a Fed chair, and we probably don't expect very, very significant policy changes, even though there obviously would be, sort of more realignments. But more than anything else, I think, my expectation is that Warsh it would be a very pragmatic central banker. I think his career in the Fed, he came in the Fed with some very strongly held views. He was able to moderate those views when he was a Fed governor, and generally speaking, he seemed to be respectful of the Fed's expertise that already existed. So we do expect some changes, but those changes, sort of at least in my opinion, are probably not going to be earth-shaking. And I think that's it for me. And so before Hadi starts talking about the yield curves, happy to take more questions. RPG, go ahead.
Yeah, I remember from the classes that we have gone through, forward guidance basically helps to increase transparency. I mean, people get to know ahead of time what is coming up and stuff like that. So getting rid of forward guidance, is it not a counterproductive idea? Or, I mean, I'm just trying to recall what's the benefit of getting rid of forward guidance?
Yeah, I think the idea of forward guidance is that it helps shape the investor expectations better, right? By providing clearer signals of what the central bank is planning to do and by actually doing what it says it does. Because then, sort of what happens is that then you start using forward guidance as a policy tool, right? You don't actually need to do something, but you can announce your commitment to something. And then investors, if they view you as credible, they start responding to that forward guidance very quickly, even if you had not necessarily taken particular actions that are consistent with that forward guidance. So as long as you have credibility, you're in a good place, right? So Warsh thinks, I believe, that forward guidance had been overused. I don't know if it would necessarily come back to the days of the Fed being more cryptic in its announcements, because reading Fed's announcements and sort of used to be a kind of as much of an art as it was of a science, right? But I think sort of any adjustments to the forward guidance are probably not going to be terribly significant. Hadi, anything to add here about the forward guidance concerns?
The only thing I would add is that probably Warsh thinks that this. I'm just trying to understand what he might mean, but by the positions that he takes, he may be thinking that forward guidance creates an obligation for the policymaker. That usually the time comes when you say, I will do this 6 months from now. 6 months from now, the situation has changed, and you may not want to stick to your promise. So if you don't stick to your promise, you lose credibility. If you do your promise, you're going to be doing some damage. So you're damned either way. So he seems to be thinking that this is wasteful type of policy. So let the market read into the future. If they trust that he's going to do the best thing for the economy, then that counts. That's what he wants.
And so in some sense, then, sort of like the concern about forward guidance is that it creates a hostage situation, right? Essentially, as an institution, the Fed is held hostage by its own forward guidance that it's issued in the past, because it also fears by the market reactions should it violate the forward guidance or do something that the markets do not expect it to do. And so from that perspective, losing that independence to market expectations is something that we want to avoid potentially, right? Or at least that's how the logic goes.
Right.
Okay.
All right, Vitaly?
Yeah, maybe a comment related to forward guidance, right? I don't know how much market really expects. I remember Alan Greenspan's time and Greenspeak when he tries to say nothing, right, with his famous quotes. I guess I should warn you, if I turn out to be particularly clear, you've probably misunderstood what I said, right? So I think market should be. Yeah, I
Yes.
think
Alan Greenspan was extremely well known for those statements, right? That's where I think a lot of frustration came from, because it literally is like reading tea leaves, right? It's trying to tell the future based on something that's very, very unclear, whether it's throwing out the tarot cards or reading the tea leaves or whatever else. Sort of my aunt who lives in Greece used to be very good at reading the coffee grounds, right? But the problem of her readings is that every time something bad would happen to you, she goes, well, I knew that would happen. And I would say, Sonia, this is not the time to warn of this, right? But if you know something is going to happen, you warn in advance. And one of your arguments was, but if I warn you, then it wouldn't happen. You wouldn't believe me. Anyway.
And second question, and I don't know if it's really relevant, but I still want to ask you. So with government debt, like
Mhm.
approaching new heights at any moment in time, right? And kind of some countries trying to use less dollar, right? Like
Mhm.
with China buying oil from Saudis and so on, right? I don't know how much of it can be dealt at like at the Fed's level. Is it even
Mhm.
their problem? But like still, it might be a trend. So how could Kevin deal with that, if it's even possible to deal with that?
And if it's even desirable to deal with that, right? Because what you're talking about is kind of this what's the name for that? Exorbitant privilege. Um, did I get that correctly? I keep forgetting this term, but sort of it's this privilege of having a currency that is used as the world's reserve currency, right? And generally speaking, sort of Fed, sort of at least the Fed statements have been is that they're not necessarily very tied to something like this, right? Sort of they don't necessarily want the dollar to be the world's reserve currency. But sure, there is alternatives, sort of coming up. So, number of countries, including China, are trying to do more trade using their own currencies. This is one of the reasons, I guess, why the euro was put together, sort of as an alternative to the dollar. But still, if you look at the volume of foreign exchange trade, right, sort of the exchange of one currency by another, the dollar, dominance, sort of used to be above 90% because remember, each transaction involves two currencies, right? And then more than 90% of cases, if you look 20 years ago, it was something like 92 or 93, dollar would be one of the counterparties, right? Over the years, this has shrunk. But by how much do you think it has shrunk? If you had
5%?
to guess. Sorry?
5%?
Yeah, probably less than 5%,
Close.
right? Sort of, I think we're looking at maybe 87% now. Again,
Okay.
don't quote me on this, but 87 plus or minus a couple of percentage points, right? So not a significant correction has taken place.
All right. Thank you. Yeah, Heidi.
But there's one caveat. If the if dollar loses its status as the sole or the main reserve currency, the fall is going to be very fast.
Mhm.
It's we suddenly are going to go from 87% to 25%.
Mhm.
It could happen very fast, and because these are unstable equilibria. When people
Mhm.
are coordinated to use the dollar is in every transaction. But if
Mhm.
they choose not to, then suddenly they go to another currency, and the currency that comes to substitute the dollar is
Mhm.
going to become much more valuable because to have because you can purchase everything you want with that new currency. That's
Mhm.
what happened to the British pound.
Mhm. It was a reserve currency until it wasn't.
Right.
Mhm.
Suddenly, within a few years, it's switched. People switched from pounds to US dollars.
Mhm.
Yep. Might happen. Okay. Thank you.
All right. Thanks for the great questions, Vitaly. Heidi, all yours.
Okay. Let me share my slides. Okay. Now, this is it. Now, yield curve, you probably are familiar with the concept of yield curve. But let me, just in case you haven't thought about it or you haven't looked into it, the yield curve gives you interest rate with different for different terms. For example, this is for February 5th, 2016, approximately 10 years ago. And here you see interest rates for 1 month was very low, about 0.25%. Then it went up if it was for 3 months, 4 months, 1 year, 2 year, 10-year, 20-year. And you see an upward sloping curve, this is the normal, this is called the yield curve, meaning that you graph interest rates versus the term of the loan. And this is the average interest rate for assets that have that kind of duration or time term. Of course, these are usually on safe bonds, so that the risk does not come into picture here. These are U.S. government bonds, or this could be also in Germany, in UK, etc. So they can usually have yield curves that look like this. Now, I chose this from 10 years ago to compare it with what we have right now. Those days, the economy was acting normally, and you had longer term debt had higher interest rates, which made sense. Because you commit your money for longer, you should be getting rewarded more. But it becomes very complicated when the economy is not in the best shape, and the economy is volatile. So here you can see that short-term interest rates, very short term interest rate is about 3.5, and 1 month jumps to about 27, 2.7, sorry, 3.7, and gets close to 3.8, and then actually declines towards 1 year. So the lowest interest rate is for 1 year from now. And after that, again, you see the process of rise in the interest rates and eventual flattening when we get to 30 years plus. So you've heard of the discussion or the statements about inverted yield curves. I assume you've heard it, but if you haven't heard it, here you can see an example. We have interest rate go up right now in the very short term. Interest rates are very low, but 1 month is about clearly higher than what we have right now. The reason it goes down from that point on to 1 year is that there's expectation that demand is not grow as much as supply grows. As the discussion we had about AI earlier when Vlad was presenting, one reason for this could be that the supply is expected to expand and the demand is going to be slow to respond. So that's why maybe interest rates are going to be lower a year from now. It could be also the sign that demand is going to go down, and supply, even if supply continues, demand going down automatically brings down the interest rate. So that's the interpretation of this inverted yield curve. The reason they call it inverted is that because it's, as you saw in normal times, the interest rate is supposed to rise continuously from the very short period overnight money rates and long-term interest rates for 10 year, 20 year, 30 years. But here we see that interest rate in 1 year is lower than interest rate in the immediate future. Okay, so one key question is what changes the shape? Here, expectations play a key role. People forming expectations about the future and how they see it. But there's also some dynamics that are interesting. For example, let me actually compare changes in the yield curve from day to day and from month to month. Here, the red line represents interest rates 1 month earlier. The red line is 1 month earlier than today, than the most recent data that we have. The most recent yield curve is the blue one, and that was in February 6th. And January 6th, we had a yield curve which was like this red one. And here you can see that between the red one and the blue one, red one being earlier, 1 month earlier, interest rates were flatter during this current year, and they seem to have jumped up a little bit during for the most recent observation, which is a few days ago. And interestingly, the long-term interest rate, if you look at the 30-year interest rate, let me actually get some pen here.
Yeah, when I'm looking at the 30-year interest rate, it's just a tiny, tiny bit lower, right? Sort of right now compared to what it was a month ago. So they do kind of converge towards the 20-30 year, but sort of generally speaking, the February 2026 interest rates are a tiny bit higher for most of those points.
Right. So exactly. So essentially, but it's saying that interest rates may be higher in the short run, but they might be slightly lower in the long run. This indicates probably that what is happening now is interest rates, the Fed over the next few months is going to actually keep the interest rates a bit higher. That's the expectation. And therefore, that will allow the economy to keep its inflation lower, and then you don't need to have higher interest rates in the future. So you have higher interest rates now, lower interest rates in the future. It smooths long-term, in terms of long-term trend. The expectation is that the economy is going to be slightly in better position in the future if you keep interest rates a bit higher. Now, this could be the effect of having Warsh as the Fed chairperson, because what was the expectation was that the three other candidates that were being considered since October or late September, the other three were much more probably much more prone to cut interest rates sharply. And when Warsh was announced as the new candidate for the position, then people realized that interest rates are not going to remain low in the short run, and they're going to be somewhat higher. And the market corrected also long-term interest rates being a bit lower, which is the blue line. Now, that's just my interpretation, that this might be the effect that Warsh brought to the market. You can't see it, of course, very closely in terms of timing, the exact day that his candidacy was announced, but probably a lot of people who are familiar with the decision making in the White House had the sense that Warsh is being looked at much more carefully, and that's why I chose a month ago to allow for the time that before the announcement, that people might have known what might happen. Now, the other thing I want to add is that from 1 month to another month, usually you don't see a big change in the market, in the curve. Now, let me add another layer here. The green line is interest rate a month before our reading in January. So 2 months before, two months ago, we had the closest day that we have is December 5th to the date for which we have data, because during weekends or holidays there's no data. So the closest I could get was December 5th, and you can see that there's not much change, but the same pattern is there. The interest rates in the short run were a bit higher and the long run was lower. But the decline it was there, and the expectation that 1 year from last December, the interest rates were expected to go down. In the past, also, 2 years were considered to be 2-year term interest rates were the lowest, but the overall shape is the same. Now, let me show you what happens if we go a little bit further back to November. Now here you can see that the short-term interest rates were much higher and long-term was also higher. So something in between in this situation may have changed. And looking at much earlier, 5 months before, looking at November, let's see, I think right. This has, I've added November now to the graph, and you can see here that short-term interest rates were much higher. They came down, but the long-term trends were similar. This is where I think September was when it became clear that Jay Powell is going to be leaving the Fed, as stepping down as Fed chairperson, and somebody else is going to come to the office. And the expectation was that that other person is going to be much more interested in lowering interest rates, because the president was saying that he wants to see lower interest rates. And that's why that's one of the factors that pushed this curve down. So if we go historically, so chronologically, or in order, the light green line curve is from September. The darker green line is from December, and you can see that interest rates are going down, and then there's another major drop in short-term interest rates from December to January, and then from January to February, there's further drop. Okay, so long-term interest rates are probably going to be seen as the same, but now that short-term interest rates are lower, you can see that over here to the right top, the long-term interest rates are higher than they would have been if the short-term interest rates had been higher, had been lower. Sorry. So now, in order to make the comparisons more complete, I also added interest rate exactly 1 year ago. And here you can see that the curve is much flatter at the first part, but much higher than what we have right now. Long-term interest rates were also expected. 30-year interest rates were supposed to be much lower. So what this curve basically is telling us, and these comparing different terms, different time frames of interest rates, it is saying that the policymaker, it's partly policymakers that are deciding where the short-term interest rates are, but the long-term ones, they don't have much influence. Even if they try to control long-term interest rates by buying long-term bonds, the influence of the Fed or the central bank is not as much as it can control the short run. And that's why a lot of policymakers nowadays focus on short-run policy rather than trying to manipulate the long run. The long run is shaped by long-term expectations of the public. And you can see here is that it's around 4.8, 4.7, and not much different, whatever was happening in the short run in the economy. I thought I'd share with you these graphs to give you an idea how one might interpret them and how one may learn from the changes in the shape and the position of the curve in order to understand what might have happened in the economy and what might be coming.
Mhm. Hadi, we have a question from Vitali in the chat.
Yes.
Vitali, do you want to voice it out?
Yeah, so like two questions just to confirm. So it's all about expectations, right? So part of it is like data science, part of it is psychology, what people expect, right?
That's correct. But keep in mind that the people who participate in the bond market are pretty sophisticated. So they realize that if the current interest rates are lowered, for example, then they expect higher inflation, and then they project higher interest rates in the future to deal with inflation, both in terms of compensating the creditors as well as the effect of trying to control inflation in the future becomes more difficult. So you have to keep interest rates higher long term.
Yeah. And the second, yeah, it's great that you've shown how those expectations were changing, right? Depending on like, oh, who might be assigned to this kind of position, right? But it's interesting to see that at the 10-year mark and definitely at the 30-year mark, they all conflate, which means that the Fed chair has only kind of short to medium term kind of impact on all of this.
Even in 5 years, you can see that there's not much change.
Right.
But the only effect that is sort of visible is that if current interest rates are higher, we're dealing with inflation, for example, we're bringing down inflation, and then that means that long term we have freer hand to keep lower interest rates.
But I wanted to also mention that, sort of looking at the evolution of this over the past year, it certainly looks like the markets believe that Fed is becoming, the Fed is being successful in the short run by taking the inflation down, right? We had, we still have higher, we still have higher interest rates, over the period of, from now to 6 months, right? Or something like that. But overall, these expectations, these rates have been gradually going down, and with the exception of the spike from of some recent spikes potentially, right? So overall, the story is a pretty good story.
Right. Very good. So, okay, let's see. All right, this is my last slide. I compared the blue one, which is current curve. The red one is exactly 1 year from 1 year before, and the green one is 2 years before. And here you can see that in 2004, the expectation was that in 1 year, 2 years, 3 years, demand is going to go, demand for money or the interest rate would be much lower than the interest rates that prevailed at the time 2 years ago. In fact, this expectation that the interest rate is going to go down, we can see that in the following year is realized by short-term interest rates being lower, and further realized by the drop between the red one and the blue one. Of course, it's not just the issue of demand, it could be also other factors, how people think about the way the Fed makes policy and influences the interest rates, or what is happening in the market in terms of what the government does, how fast the economy is growing. But the inverted yield curve is often in the literature, in the media, is interpreted as the sign of a recession coming. That's not true. It could be, if people expect a recession, yes, the yield curve could get inverted, but an inverted yield curve could also show the sign of smooth landing, an economy having high inflation, bringing down inflation without creating a recession. That kind of declining curve or inverted part is going to be there. All right. So I hope I have answered your questions, Vitaly.
So just
Yes, you did. Thank you.
one more comment here, Heidi. So I
Yes.
just want to, sort of to caution folks, to not read just one single determinant of those curves, sort of to their changes. For example, if you're looking at the most recent sort of at the interest rates as of February of 2026, right? So if you look at the 30 years, you're seeing, generally, sort of higher yield on 30-year bonds compared to what was the case 2 years ago, right? And so that increase in yields could be a number of things, right? It could be the belief that the bonds could be more risky in the future because the United States might be seen as being on a relatively unsustainable fiscal trajectory, which will require higher premiums to accommodate for higher risk, 30 years from now. It could be a belief that, sort of like 30 years from now, the level of economic activity could be higher than what we expected to happen a couple of years ago, right? It could be a number of different explanations. So make sure that you keep them in mind and make sure that you don't necessarily stick just to this, as Hadi noted, this very simple and very simplistic observations that you sometimes see in the media is that yield curve inversion basically signals economic troubles ahead.
Right. It signals some growth of production higher than demand, supply being a bit higher than demand. But that could be because the supply is expanding very fast or demand going down, maybe. So one can't be sure that there's going to be a recession. In fact, AI works and productivity goes up. If that's the case, then we will have lower interest rates with the current demand that we have. And demand could also be expanded without inflation.
All right. Well, thank you very much, Heidi. Much appreciated, folks. We are at a little after 2 o'clock, so thanks for sticking with us for a little longer. Happy to take maybe one or two last moment questions if there is any. Don't please unmute yourself and speak up.
Excuse my speech that gets interrupted sometimes because of Parkinson.
You're perfectly fine, Heidi. Anyone, any questions? All right. Well, it seems like we might
I was
be
just
done
going to
for
say
today.
thank you to both
Go
of
ahead.
you.
Yeah.
Thank you.
Clearly,
Thank you so
both
much.
Vlad and Hadi, but I know that you are a little self-conscious about your speech, but I love hearing all of your thoughts. So thank you for sharing all these with us.
That's really kind of you. Thank you.
Yeah. Thank you. Great discussion. It connects to the reality and provides like fundamental understanding of what
Thank you.
might be
Thank you.
coming.
It's
Thank you.
always great to interact with you.
Thank you.
All right. Thanks
Thank you
all,
all so much.
and talk to you soon. So be in touch. We'll post the recording on the YouTube and in our LinkedIn group shortly. We'll go from there. Thanks all. Bye for now.
Bye-bye.